The United States government is currently over $34 trillion in debt. To most people, that number is just a statistic. It is a figure so large it has lost all meaning. We see it on the news, we hear politicians argue about it, and then we go about our day. We assume that because the debt has always been there, it always will be there, and that nothing will actually change. But the debt itself is not the problem. The United States has carried debt for most of its history. The problem, the existential threat that keeps economists and military strategists awake at night, is not the amount of money we owe. It is the question of who owns the paper that debt is printed on. For decades, the global economy has operated on a simple, unspoken agreement. The United States buys goods from the world. Electronics from China, cars from Japan, energy from the Middle East. In return, these countries do not just take our cash and hide it under a mattress. They take those dollars and loan them right back to us. They buy United States Treasury bonds. They essentially fund our government, our military, and our way of life, in exchange for a piece of paper that says, I owe you. This system works because the U.S. Treasury bond is considered the risk-free asset of the financial world. It is the bedrock of the global banking system. But what happens if that trust evaporates? What happens if one morning the world decides it no longer wants our debt? What happens if the world dumps the dollar? This is not a hypothetical scenario about a stock market crash or a recession. This is a breakdown of the mathematical engine that allows the United States to function as a superpower. If foreign nations stop buying our debt, or worse, if they begin to aggressively sell what they already hold, the consequences will not just be lines on a chart. It will be the immediate, systemic cessation of the American economy as we know it. To understand how this catastrophe unfolds, you first must understand the trigger mechanism. It begins in the bond market. Right now, foreign nations hold over $7 trillion in U.S. government debt. Japan and China alone hold huge percentages of this. These nations have held this debt for years because it was stable and paid interest. But let's assume a geopolitical fracture occurs. Perhaps a conflict over Taiwan, or a new trade alliance among the BRICS nations. Brazil, Russia, India, China, and South Africa decides to bypass the dollar entirely. The first sign of the collapse won't be on the news. It will be in the overnight markets. A major foreign holder, let's say China, decides to liquidate a significant portion of its treasury holdings. They put hundreds of billions of dollars worth of U.S. bonds up for sale. In any market, when you have a massive surge in supply and no increase in demand, the price crashes. As the price of U.S. Treasury bonds plummets, the yield or the interest rate the U.S. government must pay to borrow money skyrockets. This is the mechanical relationship that governs global finance. Bond prices go down, yields go up. Why does this matter to you? Because the yield on the 10-year U.S. Treasury note is the benchmark for almost every other interest rate in the economy. Within hours of the sell-off, interest rates in the United States would explode. We aren't talking about a quarter-point hike by the Federal Reserve. We are talking about rates jumping to 10, 15, or 20% in a matter of days. The mortgage market would instantly freeze. No one can borrow money for a house at 20% interest. The housing market, which makes up a massive chunk of American wealth, would become illiquid overnight. But the housing market is just collateral damage. The real target is the U.S. government itself. The federal government relies on selling new debt to pay off old debt. It's a credit card that acts as a national budget. If interest rates spike to historic highs, the cost of servicing the national debt becomes mathematically impossible. The government would be forced to print trillions of new dollars just to pay the interest on the money it already owes. This creates a feedback loop of doom. The more money the Federal Reserve prints to save the bond market, the less the dollar is worth. The less the dollar is worth, the faster foreign nations want to sell their bonds. It is a death spiral. As this financial panic spreads, we hit the second domino, the end of the petrodollar. Since the mid-1970s, there has been a global standard that oil is sold in U.S. dollars. If France wants to buy oil from Saudi Arabia, France must convert its euros into dollars first. This creates a permanent, artificial demand for American currency. Every country needs dollars because every country needs energy. This system is the primary reason the US dollar is the world reserve currency. But in our scenario, as the dollar destabilizes, oil-producing nations will act to protect their revenue. Saudi Arabia, the UAE, and other OPEC nations would likely announce they are moving to a basket of currencies, or simply accepting gold or Chinese yuan for their oil. The moment this announcement is made, the artificial demand for the dollar vanishes. Trillions of dollars that are held in reserve banks around the world, in Europe, in Asia, in South America, are suddenly useless to them. They don't need these dollars to buy oil anymore. And if they don't need them, they don't want to hold them, because the value is dropping. This triggers what economists call repatriation. It is the economic equivalent of a tsunami. All those trillions of dollars held overseas come flooding back to the United States. They are exchanged for tangible assets, land, companies, gold, anything with real value. This flood of currency entering the domestic supply triggers hyperinflation. Not because we printed more money, but because the money that was exported for decades has suddenly come home. Now, we have reached the final and most devastating phase, the import freeze. The United States is an import-dependent nation. We run a massive trade deficit, meaning we buy far more from the world than we sell to it. We rely on imports for our electronics, our pharmaceuticals, our clothing, and a significant portion of our industrial machinery. When the dollar loses its status as the reserve currency, its purchasing power on the global market collapses. If the dollar loses 50 or 60% of its value against the euro or the yuan, the price of everything we import doubles or triples overnight. But it's worse than high prices. In a rapidly crashing currency scenario, foreign exporters often simply refuse to accept the currency at all. A supplier in China or Germany will not put goods on a ship bound for Los Angeles if they don't know what the dollar will be worth by the time the ship arrives in 3 weeks. They will demand payment in a stable currency, or they will demand gold. The ports stop working. Not because of a strike, but because of a transaction failure. The supply chain of the United States, which operates on just-in-time efficiency, grinds to a halt. Pharmaceuticals are a critical vulnerability. Most of the active ingredients for American antibiotics and generic drugs are manufactured in China and India. If trade settlements break down, the flow of these medicines stops. Hospitals would face immediate shortages of critical drugs within weeks. The industrial base would follow. Factories that assemble cars or appliances in the U.S. rely on parts from overseas. Without those parts, the assembly lines stop. Layoffs begin immediately. The unemployment rate would spike in response to the trade freeze. In the end, the dumping of the dollar is not just a banking crisis. It is a realignment of global power. The United States would lose its exorbitant privilege, the ability to print money to pay for real goods. We would be forced to live within our means for the first time in a century. The government would likely respond with capital controls, forbidding citizens from moving money out of the country. They would issue a new currency, likely a digital dollar, to reset the system. But the transition would be chaotic, painful, and it would mark the end of the American era of economic dominance. The dollar would no longer be the king. It would just be another currency, struggling to survive in a world that has moved on. Comment below if you think the dollar will collapse. If you found this valuable, smash that like button, subscribe for more content like this, and hit the bell so YouTube actually shows you my next video.